Thanks for clicking. The Bank of Canada is getting increasingly worried about the ability of Canadians to service their household debt. This according to the release of the bank's financial system review. According to the review, while households are, for now, managing their debt payments, pockets of strain are emerging, especially for those borrowers who purchased homes between 2020 and 2022. Following the release of the report, Governor Tiff Macklem and Deputy Governor Carolyn Rogers held a press conference where reporters asked about a half a dozen different times, half a dozen different ways, if we can expect rate cuts coming anytime soon.
You're very determined on monetary policy, aren't you?
It's all I have.
Yet despite the mounting evidence that the Bank of Canada is between a rock and a hard place, with Canadians buckling under the pressure of the higher rates, but inflation still running hot, reports are continuing to come in, heralding the beginning of a new real estate boom. So what I want to do today is go over the financial system review that was just released, take a look at the Bank of Canada's press conference that followed the release, and then discuss what to look for next. The bank's next interest rate announcement is only a few weeks away, and with bond yields already up 40 basis points since this point in time last week, some are starting to predict a further 25 basis points in rate hikes. We'll obviously have updates out on that rate announcement on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. The report is explicit in its worries over the mounting level of Canadian household debt. According to the Bank of Canada, those who bought during 2020 and 2022 are carrying 17% more credit card debt than those who purchased between 2017 and 2019, leading the bank to assume that households are relying on their credit cards in order to finance their debt. And the bank notes that arrears on those credit cards, late payments on those credit cards, have already risen to pre-pandemic levels.
You've been spending like a drunken sailor all last week.
And to put that into context, credit card arrears, credit card delinquencies may be at pre-pandemic levels, 2019 levels, but the inflation rate in 2019 was 1.94 versus the 4.4% that it is right now. So, pre-pandemic in 2019, when credit card delinquencies were this high, the Bank of Canada had a lot more tools at its disposal in order to re-stimulate the economy, lower interest rates. And the bank is predicting more strain on mortgage holders going forward, as more and more mortgages come up for renewal. The bank predicts that the median increase in mortgage payments between 2023 and 2026 is set to rise by 20%. However, the bank says that payment increases will be much more severe for those holding variable rate mortgages with fixed payments, predicting that those borrowers will see a 40% increase in their mortgage payments over the next 3 years. So that's a massive strain that's going to be put on Canadian households over the next 3 years, if the Bank of Canada is correct in its predictions.
And even a broken clock is right twice a day.
And Deputy Governor Carolyn Rogers stressed at the press conference that the major worry is that high household debt, combined with a recession, could eventually work its way into the banking system.
However, in a severe and prolonged recession, mortgage defaults could rise, leading to credit losses for lenders. That, in turn, could lead to a further pullback in credit, worsening a downturn.
So the real worry is that if Canada enters into a recession, if Canada enters into a prolonged recession, these high debt levels could inhibit borrowers' ability to make their payments. And if the banks see widespread defaults, widespread insolvencies, they could in turn tighten credit even further. With that said, Deputy Governor Rogers said that there were a few options available for households in order to cope with those higher payments.
The other thing to keep in mind is there will be mitigating factors. So normally, if you're renewing a mortgage that you took out 5 years ago and you see a jump in payment, it's very likely you will have had some increase in income that will offset that payment.
And they'll make more money.
Indeed, with the Bank of Canada actively trying to induce a recession, it's not exactly clear that that argument, that solution, is genuine. So, Canadian households are buckling under the stress of higher mortgage rates. It's not likely to get any better over the next 3 years, with payments increasing between 20 and 40%. And Bank of Canada Governor Tiff Macklem took time to stress that these higher rates are going to be the new normal.
Going forward, nobody should expect that interest rates are going to go back down to the very low levels that we've seen over the last decade or so. So we're in a transition period to a world where interest rates are going to be higher than what many people have gotten used to.
So the governor doesn't foresee rates going down anytime soon. He doesn't foresee mortgage rates coming back down to those 0%, near 0% levels. And the governor had to stress that on multiple occasions as reporters took multiple different avenues to try to ask the same question. When can we get interest rate cuts?
I'll repeat what I just said. We're using this pause to assess whether we've increased interest rates enough to bring inflation back to target. There is no hint of cuts in that statement. It is far too early to be thinking about interest rate cuts.
So it's possible, right?
The bank was then asked about the longer amortizations being offered by the banks to holders of variable rate mortgages with fixed payments that we've talked about so many times on this channel. The deputy governor said that while those longer amortizations are good for current homeowners to cope with the stress of higher interest rates, she wouldn't want to see them implemented system-wide.
So we would rather see amortization extensions used on a sort of borrower by borrower situation as a sort of stress release valve rather than a sort of structural change to the mortgage market.
And the reason, says the deputy governor, is that it would remove the safety valve, in that if households started off with a 40-year amortization, they would have nowhere to go if they faced financial hardship.
What about just structurally changing amortizations and increasing them across the board? We don't think that's a good idea for exactly the reason that removes the buffer that households have when they face stress. So
I had wondered how the government was going to justify longer amortizations to the public at large. Why is it safe for current homeowners who got in when rates were 1%? Why is it safe for them to have 40-year amortizations, but it's not safe for prospective homebuyers? Apparently, it's for their own safety.
But I think a modicum of gratitude would not be out of line here.
And we'll obviously get into this in other videos as it's beyond the scope of this one, but this idea that current homeowners can have longer amortizations and prospective homebuyers can't have them as well is ripe for abuse. So, judging from the Financial System Review, judging from this press conference, the Bank of Canada is well aware of the effects that its monetary policy is having on Canadians, on the Canadian economy. With that said, this doesn't appear to be a central bank that is going to be reversing course on interest rates anytime soon. At least for now, this does appear to be a central bank that is in it for the long haul, warning Canadians that not only the past couple of years, but rather the past decade of lower interest rates are a thing of the past. And yet, despite the worries coming from the central bank, despite the increase in the number of insolvencies in Canada, despite the number of credit cards falling into arrears, we still see a number of predictions about a resurgent real estate market. But if what Governor Macklem said today is true, if the Bank of Canada is planning on interest rates being higher for longer and us not returning back to those near zero interest rates that we've seen over the past decade, then it's not clear that the real estate market is going to be able to withstand these stresses. However, as we've talked about so many times on this channel before, what the Bank of Canada will do in the face of a financial crisis is a whole nother story. If we do see a major problem with Canada's banks, which the Bank of Canada is already warning about should we see mass defaults on the part of Canadian homeowners, then the bank could change its tune very quickly. With all of that said, we will have a much better idea on the Bank of Canada's course when they make their interest rate announcement on June 7th, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.